What are the tax consequences of a loan granted to a Polish company by its foreign shareholder? This will be discussed by Jakub Macek, attorney at law, tax advisor and partner in Wardyński & Partners Tax Practice, who advises clients on how to arrange tax-efficient business financing structures. Then I will tell you about what is happening in the Polish economy.
Today, I would like to focus on the tax implications of a Polish company being financed by shareholders through debt. The topic is broad, so I will just focus on the areas that are crucial for tax risk management. Apart from equity financing and some hybrid solutions in the form of supplementary payments, the most common financing of a subsidiary is through loans. Now, I will take a look at the major tax consequences of a loan financing at various stages of a loan's lifetime. Firstly, the provision of a loan is generally subject to civil law transaction tax, which is a stamp duty charged at 0.5% of the nominal value of the loan. In this sense, the civil law transaction tax cost of a loan is similar to the tax cost of an increase in equity. There are certain exemptions from taxation, the most important being that a loan advanced by a direct shareholder is exempt from tax. Also, a loan granted by non-Polish financing entity is also exempt. This usually applies to a typical group FinCo. The terms and conditions of a loan, in particular its interest rate, need to comply with the arm's length rule. In other words, a loan between related parties has to be on the terms that reflect market standards. Also, the Polish borrower may have to comply with Polish transfer pricing regulations, including reporting. For several years, Polish tax legislation has been simplifying small intra-group loans. If the indebtedness between parties is below 20 million PLN and certain other conditions are met, then the so-called safe harbor rule may apply. Under safe harbor regimes, the interest rate on a loan agreement may be agreed at the level announced by the Polish Ministry of Finance. For example, 3 months Euribor plus a margin of between 2 and 2.9 percentage points. Benefiting from safe harbor not only protects a Polish company against the Polish tax authority assessing an interest rate, it also means that the Polish company is no longer required to prepare statutory transfer pricing documentation for the loan agreement. The disadvantage of the safe harbor is that it is considered to be a tax arrangement that is subject to mandatory disclosure rules, hence requiring additional reporting. From a tax perspective, the moment of particular significance is when the interest is paid. If a Polish company is paying interest to a foreign lender, it generally must collect withholding tax at a rate of 20%. This tax rate may be reduced by a double taxation treaty or a domestic exemption. However, if total payments to a given recipient, including not only interest, but also dividends and royalties, exceed 2 million PLN, then the so-called pay and refund system will apply. Under the pay and refund system, the Polish company must collect tax at the statutory rate of 20% for any amount in excess of 2 million PLN. After that, the recipient may apply for a refund of the overpaid tax. The Polish company may only apply for a refund if it has borne the economic cost of the tax, for instance, based on the gross-up clause. Since pay and refund adversely affects cash flow, two scenarios should be considered in applying withholding tax relief upfront. The first scenario involves obtaining an opinion on eligibility for the withholding tax benefit. The disadvantage of this is the average time for receiving such an opinion, which is about 1 year. The second involves a statement filed by board members. The statement's signatories confirm that the company has exercised due diligence in ensuring its eligibility for withholding tax relief. At first glance, this solution may seem tempting, but if the statement turns out to be untrue, it could lead to severe consequences, such as criminal liability for the board members and an additional tax liability for the company. That said, before filing the statement, a very thorough analysis should be carried out to protect the board members and the company against any adverse consequences. Debt financing is a common way of funding subsidiaries, not only because of its flexibility, but also because it enables at least part of profits to be distributed by interest payment. Unfortunately, the introduction of pay and refund has caused much confusion and has negatively impacted intra-group cash flows. The coming months will show how that influences market practice.
The shelling of Ukrainian ports by the Russian aggressor since February 2022 has drastically reduced Ukrainian agricultural exports, especially grain, via the standard route, i.e. by ships across the Black Sea. Taking advantage of the fact that the European Union, in order to help Ukraine, has allowed duty-free entry of Ukrainian agricultural goods into its territory, Ukraine therefore began to export them overland, also through Poland. Ukrainian grain, much cheaper than Polish grain, was to be transported through Polish territory in transit to ports on the Baltic Sea. From there, it was then to be sent to a number of African countries entirely dependent on grain imports. However, transit proved to be leaky, and some Ukrainian grain was sold on the Polish market. This led to its destabilization, a drastic fall in the price of Polish grain and oversupply in warehouses. This situation caused violent protests by Polish farmers, demanding that the market be protected from flooding by cheaper Ukrainian crops. An embargo was therefore introduced on imports of Ukrainian grain. As there is presently no sign of an imminent end to the war, the European Union will have to develop more effective, long-term mechanisms that reconcile the interests of EU and Ukrainian farmers. Thank you for watching this episode. See you next time.